Every time prices rise, we hear the same explanation. It was unexpected. It was temporary. It was caused by supply chains, oil, or global conflict. Inflation is framed as a mistake, an economic accident, a storm policymakers are desperately trying to control. But what if that's not the full story? What if inflation at certain moments becomes useful? And what if usefulness changes incentives? Setting the stage, money before flexibility, before modern central banking, money had limits. Under the gold standard, currency was tied to metal. Governments couldn't print freely. Spending required taxation or honest borrowing. Inflation existed, but it was constrained. Long-term price stability was common. Then came World War I. Governments faced enormous costs. Taxes were politically dangerous. Borrowing alone wasn't enough. So gold convertibility was suspended, money printing accelerated. Inflation surged across Europe, currencies weakened dramatically. But something unexpected happened. Origins, the first strategic lesson, governments' war debts became easier to manage. Not because they repaid more, but because the currency lost value. Debt shrank in real terms. Inflation diluted liabilities. The burden shifted quietly. Savers paid the cost. Debtors felt relief. The lesson was subtle but powerful. Inflation can reduce real debt without direct taxation. RISE, the era of fiat money. After World War II, the Bretton Woods system tied currencies to the US dollar. The dollar was tied to gold. For a while, stability returned, but deficits began to grow. Wars and welfare expanded government spending. Gold reserves drained. In 1971, convertibility ended. Money was no longer anchored to metal. It was anchored to policy. Central banks gained flexibility. Money supply could expand without physical constraint. Inflation became easier to generate and easier to manage, at least in theory. Breaking point, the 1970s experiment. The 1970s delivered double-digit inflation. Energy shocks worsened the situation. Confidence wavered. Savers were punished, but government debt burdens eased. Nominal GDP rose rapidly. Tax revenues increased automatically. Debt to GDP ratios stabilized. Then came Paul Volcker. Interest rates were pushed above 15%. Recession followed. Inflation was crushed. Credibility was restored. But the system remained fiat. The debt era incentives shift. Fast forward to the 21st century. Global debt exceeds $300 trillion. Governments carry massive deficits. Corporations rely on cheap borrowing. Households finance homes and education through credit. In this environment, deflation is dangerous. Falling prices increase real debt burdens. Defaults multiply. Economic contraction deepens. Inflation, by contrast, softens debt. Modern expansion minus 2008 and beyond. In 2008, financial markets collapsed. Central banks cut rates to near zero. Quantitative easing began. Trillions were created electronically. Asset prices recovered quickly. Stock markets soared. Housing rebounded. Wealth inequality widened. Then the pandemic struck. Stimulus spending reached historic levels. Money supplies surged at record speed. Inflation followed. 4-decade highs appeared in multiple economies. Central banks responded with rapid rate hikes. Growth slowed again. The cycle repeated. Fallout, who benefits? Scene 89. Inflation erodes purchasing power. But it also quietly reduces the real value of debt.